Warning, this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel and welcome to the weekend's deep dive. We, on the weekends, like to come back and outline the hypothesis, okay, and check to see if everything is still going, roughly speaking, according to plan. If anything is invalidated, I want to know so that I can adjust my stance, so that I can figure out where I'm going wrong. But if everything's still operating within my framework, within the base case hypothesis, then I can have full confidence in my assessment that we are positioned correctly, we have a good read on the market, and ultimately it's not about being right or wrong, it's about staying on the right side. So as it stands, we are still rocking with this idea that at the lows we were too bearish and we were going at all-time highs for the stock market and for Bitcoin, that this cycle would be different. We'd hit an all-time high before the halving, ultimately form a left translated top, meaning before November of this year, and then begin a decline into that 4-year cycle low due sometime late 2026. When we fast forward to today, the stock market is behaving exactly as expected, so happy days there, okay? Not much more to say about that. I don't like to use parabolic curves. Instead, I like to use 3 increasing angles of attack using these trend lines, 1, 2, and I believe we are entering 3. Now, there's a good chance that perhaps we've got to find a daily cycle low in the not too distant future, and then we'll set a third, even more vertical angle thereafter. But for now, as you can see, the idea was we were going to have this blow off top before ultimately culminating in a global recession and deflationary bust. And so far, it certainly seems like that is in play for the stock market. As I was saying, for Bitcoin, the idea was to make an all-time high before the halving and ultimately form a left translated cycle top. So far, this is the only missing component of the thesis, right? You're going to see the macro stuff in a minute. All of that seems to be going as expected. But the one thing I thought we would see by now is Bitcoin significantly more parabolic than it is. You can see when I pull up a Bitcoin chart, we are barely hanging on to this second angle of attack at the moment. And the only missing component, as I was saying, is we haven't seen that third and final angle come in like we have for the stock market. The whole price action and correction of late has led a whole heap of people to be very bearish. But as it stands, and I'm about to show you a few things that support this point, I do think we still have a shot at putting in that third and final angle. Of course, it's entirely possible that it's not going to do this, and thus the hypothesis will be correct only up to here for Bitcoin. It'll be correct for everything else, and perhaps if we don't see this third angle come in, then maybe I got the Bitcoin portion slightly wrong. But as it stands, unless we lose this second angle convincingly, unless we trade below these current cycle lows right here, then I remain cautiously optimistic, and I still think there is a good shot at seeing this third and final angle come in. The reason I say that, as Naba points out here, is back in June of 2023, we were here, okay? Correcting into wave 2 before 3, 4, and that final 5th into what I believe will be a left translated cycle top. And an update on this, we are now here. 3 into 4 before that final 5th. That final 5th in the Elliott wave system corresponds with my third angle of attack, and this top should still probably be in that neighborhood of left translated. If it's slightly right translated, I don't really care. My primary focus, as always, is getting out as close to the top as possible, flipping short and figuring out how to protect the gains thereafter. But you can see, whilst everyone thinks that this third and final angle is ridiculous and impossible to achieve, and whilst it remains, objectively speaking, the only missing component from this whole hypothesis, I still think it's reasonable to expect, both from an Elliott wave and a cycle perspective, that we will see that third and final angle come in the not too distant future. I was playing around with a compound interest calculator yesterday, and here's what I noticed, okay? If and when we set that third and final angle, Bitcoin should average around 4% per day until it breaks down. Meaning, once this third and final angle is set and we start to trend up like this, assuming this is what we do, okay, we should be, for this entire period here, yes, there will be pullbacks along the way, of course, but for this entire period in here, we should be expecting an average gain of around 4% per day. And if that's the case, that would take us from 58k to 226 in just 8 weeks. And I know a lot of people here will be saying, what on earth is this guy spoken? Many of you know. But the truth is, if you go back and look at the prior 2 bull runs, during their third angles, okay, they hit an average of 9% a day. So it's actually quite conservative to expect 4% a day. And of course, this is just an average if it were to last 8 weeks and if it were to start from 58k. Of course, if it goes less than 8 weeks in the third angle, then this number will be smaller. But ultimately, something akin to this would actually be normal and to be expected, even though most people's brains can't comprehend it, right? But as I said, in the prior 2 bull runs, we did 9% a day in their third and final angle. So if we really are here, about to enter that fifth, okay? And if we really are, therefore, about to set a third and final angle, there's a very good chance most people are not ready for the extremes that could be achieved. So there's your hopium for the day. As I said earlier, objectively speaking, everything is going according to plan apart from this third angle for Bitcoin. This is the only missing component. It does not mean it's guaranteed, okay? By any means, I'm by no means saying that it will show up in the next few days, although like I said earlier, I remain cautiously optimistic. But until we get true invalidation, closing below these lows, breaking down of this second angle convincingly, then it is quite difficult for me to just abandon ship. I think experience has taught me to be patient, let the price action develop, and depending on what exchange you use, this is my preferred look on the Bitstamp. You can see so far we haven't yet recovered this second angle of attack, okay? So depending on the exchange, depends on the damage. If you use the CME looks even better. So that's kind of interesting. And of course, we could be looking for a rollover from here. But if we don't get that, then we will be seeing bullish price action. If we see bullish price action, I think we should be open to seeing this fifth of the fifth come in before that bear market decline into the end of 2026. Also of note, very good chance we have found a weekly cycle low here, okay? So not just me saying it, you can see Tony the Bull asking the similar question, okay? Is that cycle low already in? Is this the weekly cycle? And are we therefore about to trend up something like this, okay, before then declining into the next weekly cycle low? Based on everything I've shown you so far, I am not ready to discount this idea. I am still cautiously optimistic about seeing that third and final angle come in, and the stock market backdrop is somewhat supportive of this. I know the divergence of the stock market going up whilst Bitcoin has been correcting has got a lot of people on edge. It's not something we see very often. However, with that said, objectively speaking, we did see it back in this neighborhood as well. The stock market was rallying whilst Bitcoin was building a base. And then, of course, Bitcoin played this massive omega game of catch up. So from a market perspective, like I was saying earlier, we're expecting these blow off tops. Bitcoin's third angle is the only missing component, but I'm not yet ready to discount it. Moving into the macro, okay, I've been saying over and over again, the market is wrong about inflation. Everyone seems to think inflation is sticky. Everyone seems to think we can't continue a period of disinflation before ultimately slipping into asset price deflation. Everyone keeps looking, in my opinion, at coincident data like the M2, which is creeping up as of today, but negating the fact that anything you do to the M2 rate of change takes around 18 to 19 months to show up in the inflation data. And thus, when we saw this snapback followed by a sideways wobble and a move down, that has presented in CPI with this move down, a sideways wobble that the market, I believe, has gotten wrong in thinking that this is sticky inflation. And as I've been saying over and over and over again, I therefore think this last piece of the puzzle here should present over the coming months in the CPI print. Thus, we should continue to expect CPI to come off, continue to see disinflation before ultimately slipping into deflation. Of course, printer will eventually come back. This M2 rate of change will, of course, eventually turn back up to the upside. And then anything that happens here will show up in the CPI with around an 18-month lag. But as I've been saying over and over again, I think people don't really understand that anything you do here shows up here with a lag. And instead, they're just looking at the hard right edge and saying, well, M2's going back up, so inflation's going to be sticky. And they don't understand that this wobble is what's presenting as sticky inflation, when in fact, inflation is probably going to continue to come off. The reason this component is so important is because of the Goldilocks rule. When we swing from a highly inflationary environment towards deflation, okay, there's a period in the middle known as the Goldilocks zone where things don't look so bad, and that is usually where the market will rally. In addition to that, the more inflation comes off and heads towards that 2% target that the Fed has got, the more the market can see the light at the end of the tunnel pertaining to interest rate cuts. And of course, the market will front run those rate cuts, which again contributes to the parabolic blow off top nature of this stock market. Every week I also show this, that the TMC Global Credit Impulse leads CPI by 18 months, and you can see, based on the orange line, we should continue to expect this inflation before ultimately slipping into deflation. That is, of course, what we've been seeing of late as well. This week we went live for the CPI data. The CPI data came in cold and was even deflationary month over month. Admittedly, not as cold as I would have liked to see it, but it doesn't really matter because they make the data up anyway. What's interesting, what's important is the direction and the trend of that data. So long as it continues to come down, then it continues to fit this idea that this part of the curve will indeed continue to present in CPI. Going back to June, we had core CPI excluding shelter also showing deflationary numbers month over month. And that again is what we saw in the CPI month over month this week. So the data does continue to move down. Like I was saying over and over again, I really do think the majority of the market believes sticky inflation is here and is not going anywhere. And I also believe they are wrong. I think over the next 1 to 2 prints, we're going to really start to see these 3s turn into low 2s and even 1s. That would make perfect sense based on this. We should start to see a true acceleration to the downside. The Fed, remember, is late to react on the way up, okay? Doesn't want to hike immediately, wants to be late to the party, and now it's going to deliberately be late to the party to cut the rates on the way down. Core PCE also continues to move down as well, another inflation metric. And if I pull up this chart, it's one of my favorite charts, okay? We are now starting to slip into this neighborhood, which means we are indeed getting that down, sideways wobble and down. So based on everything we've seen, okay, the markets are indeed rallying because they are in that Goldilocks zone, because they are front running the onset of the Fed cutting cycle. There's a lot of debate out there as to whether or not rate cuts are bullish or bearish. And everything depends on context. If we cut as part of normalization, the markets can continue to rally for some time, and stock market performance is usually favorable thereafter. But I have been making the case that these cuts will not be cuts into normalization. They will be cuts because something has broken. I don't even think it's broken by accident. I think this is all a controlled demolition, but that's a conversation for another day. The unemployment rate is breaking out of a range, okay, and is currently sitting at 4.1%. Why that is so significant is the Fed had a 4% unemployment target for the year end 2024. We are north of their end of the year target, and we are only halfway through this year. Unemployment as well doesn't tend to do this, what it's doing now, and then roll over again. It doesn't tend to do that. Usually what we see is this starts to get worse and worse and worse, and then we get acceleration to the upside, as you can see back here. This is very normal and to be expected, and thus, instead of having cuts into normalization, I have been suggesting that what we are going to see is unemployment spike, we're going to get a global recession, things break down, and thus those rate cuts are going to be cuts because something has broken and because the Fed need to cut into a recession, which does not qualify as normalization, and thus the stock market is not expected to do well. It is expected to undergo this recessionary crash before ultimately slipping into asset price deflation, meaning negative CPI data. So it's absolutely a wild time to be alive, but unless this unemployment data does something it hardly ever does, which is roll back over in here, okay, then the writing is on the wall, both pertaining to the inflation declines and pertaining to the fact that unemployment continues to get worse and worse and worse. The CME had not been pricing any cuts until the most recent CPI data came out. But after the CPI data, we now currently sit at a 90% probability we will be seeing cuts no later than September. This has been one of the biggest repricings this year, and so this tells us to expect cuts no later than September. I have been making the case that if something breaks, if the labour market continues to deteriorate, and if I'm right about inflation starting to really accelerate to the downside, then I've been speculating we might even see these cuts come sooner than September. And of course, the signal for this is the US 2-year yield. Every time this 2-year yield moves lower, we see the onset of a Fed cutting cycle thereafter. You can see that happened in every single one of these cases. Here, and here were not cuts into normalization. They were cuts because something broke. This was C19, this was the GFC, and this was the dot-com bubble. I have been making the case again that what we're going to see is the 2-year yield move lower, indicating that the Fed cuts are coming much sooner than people are ready for. And again, as I said earlier, this is not going to be cuts into normalization. This is going to be cuts because something broke and we're about to enter a recession. And when we see cuts because something is broken and we're about to enter a recession, just like here, and here, you can see the top comes in for risk and the stock market very, very soon after, usually within about 2 months of that first cut. So if we're going to get cuts somewhere between July and September, say, it tells us that 2 months either side of that first cut, we'll see the Fed funds rate start to do this and perhaps a market top in the not too distant future. Like I said, within 2 months of the onset of that cutting cycle. So we continue to monitor the 2-year yield to see if it starts to morph into a look like this, because if it does, it tells us, as I said, that those cuts are coming sooner than people are ready for. When we hop into the US 2-year yield, what do you see here? Okay, I've been saying over and over again, you don't think rate cuts are coming? Well, tell that to the bond market, because the bond market has been signaling to us that the Fed is getting ready to cut. It is almost ready to cut a little bit further to the downside, and we will have well and truly morphed into a look like this on the green line, telling us that those rate cuts are coming very, very soon. And as I said over and over again, the reason this is so important is because in amongst a sea of people and investors saying things like, well, the market's going to keep rallying because rate cuts are stimulative, because rate cuts are bullish. Actually, the context is everything, and the context of these rate cuts looks a lot like here, and here, where the stock market entered recessionary periods and big declines to the downside. And last but not least, the biggest pushback we get on these ideas is that the global liquidity cycle is up until late next year. and thus risk assets can continue to move higher well into the end of next year. Before then, that liquidity cycle tops and we see the true recession, the top come in for that 18.6 or 7-year real estate cycle. And I have been pushing back against this very, very hard, because back here in 2006, okay, liquidity was increasing the entire time, and yet we went into the GFC, okay? So don't believe that just because liquidity is going up, that means we're going to be able to avoid a recession, especially with the labour market deterioration and the CPI coming down as violently as it is. I believe the Fed is already late to cut. Again, they're going to continue to drag their heels because I think this whole thing reeks of a controlled demolition. It's also of note, in case you're new here, that the liquidity cycle bottom in 2006 marked the pico top of the housing market before the subprime mortgage collapse. So liquidity can and will continue to increase, but that does not necessarily mean that the stock market, Bitcoin, crypto, et al. Is all going to continue to move up with it. And again, it speaks to, if we do indeed see these cuts come as late as September or even before, right, then how is it that we do not morph into one of these looks? You tell me. I think we're going to see the top much sooner than people are actually ready for. As ever, we'll keep taking it one day at a time. We'll keep being open to all possible outcomes. But as you can see, based on everything I've been saying, we've been calling for 1, continuation of disinflation before deflation. So far, so good. 2, we've been calling for continued labour market deterioration and ultimately a big spike in unemployment. So far, so good on that one as well. We've been looking at slowdown in the economy. Again, we've been showing that at these weekend deep dives. The US GDP continues to decline. 4, we've been using the bond market to let us know when the Fed is getting ready to cut. And we've been on top of this way ahead of most people. Given that cuts are now priced for September at the latest, I would say that is no surprise to the Camel Crew, and again, is entirely normal and to be expected. And then, of course, pertaining to the charts and the market structure, we have the stock market putting in its blow off top. Happy days there. We did a fantastic job at capturing this move, hopping in and out the whole way up. And for Bitcoin, we did really well at calling the all-time high before the halving, until of late when we got into this little bit of correction, a little bit of a wobble. Like I was saying earlier at the start, the only missing component is that third and final angle for Bitcoin, but I am not ready to discount it yet. And so overall, I'm more than confident in my read, in my assessment. I am more than happy to sit here and say everything is moving more or less in accordance with expectations. Therefore, I continue to accept my hypothesis is, for now at least, in play and is yet to see any major invalidation. The current stock market position after we hopped out of the prior one is sitting happily in profit. We are getting late in this daily cycle, so we'll be looking for a daily cycle low decline any day now. The same is true of the NASDAQ, and we'll be looking to add some more exposure and move the stops up from the initial positions underneath wherever the cycle low forms. The Dow Jones is thinking about moving into price discovery, into expansive territory, and I think it will be about time to set that third and final angle in the not too distant future. Even the Russell 2K is starting to move higher, as you can see here. There's a whole sea of narratives surrounding this. I'm seeing some accounts push the idea that we need this thing to expand for the crypto market to go up. And to that, I simply say you're wrong. The correlation is not causation. Something else I keep seeing people getting wrong about this is people are calling this rotation. They're saying, well, the NASDAQ's down, okay? And that's because people are rotating out of big tech and into the Russell 2K. This is absolutely false as well, okay? What we are getting is simply a decline into a daily cycle low for the S&P and for the NASDAQ before they then come swinging out of here in perhaps what even might be either the third angle or even a fourth angle to the upside, okay? So make no mistake about it. Whilst people are sat here saying, that's it, that's the top. I see a lot of top callers here, okay? No way. This thing is going way, 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 way higher. This is not parabolic enough yet. We are not experiencing rotation into small caps, okay? We are experiencing something that only happens towards the end of multi-decade cycles, and that is where we get breadth widened towards tops. In all other tops, if you go back and check the breadth, what you will find is breadth narrows towards tops. It does not widen out. This is highly unusual. This, again, is another thing a lot of people in the market keep getting wrong. And I think a great deal of that is down to laziness. A lot of people just keep parroting each other's ideas. They hear somebody say something like, for example, we need the Russell 2K to move up or crypto is not permitted to move higher. Or, for example, they say, well, the NASDAQ has pulled back this week by a few points, and thus we are calling tops in the NASDAQ and saying we're seeing rotation into small caps. No, 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 no. Okay? Do not parrot these people that don't know what they're talking about. Instead, verify what they are saying. Okay, go back and check the historical data. The Russell 2K breadth in general does not widen towards tops. It's only doing this because we are late in the multi-decade cycles. This is completely abnormal. That's what makes this call so strange. Okay, for me to be calling for the Russell to hit north of 2.7, 2.8, even 3K in this final leg higher would not have made any sense at any of the prior all-time highs and parabolic blow-off tops that we saw saw, for example, in 2008 or 2000. It doesn't make any sense. That is not typical for what we see. And if you think that somehow the Russell 2K needs to expand to give crypto and Bitcoin permission to move higher, then I don't know what to tell you, okay? But correlation does not equal causation. Bitcoin doesn't care. And I know some people say, yeah, well, Camel, isn't it related to risk? No, it's not, okay? It's not. This is a completely orchestrated, manipulated move higher to let big players out and to trap people into thinking this is a huge risk-on move. It is not a huge risk-on move, okay? This is a manipulated move higher. This is going to be part of those end of those longer multi-decade cycles coming to an end, letting the big players out before we experience what could potentially be one of the nastiest recessions and downside moves that we've seen since 1929, which of course was the Great Depression. I say this not to be a doom mongerer. I say this as somebody that knows and understands where we are in these cycles. So please, please, please don't put anything in my comments about, oh, the Russell 2K is expanding. That means we're going to have alt season, okay? You don't know what you're talking about. These people are just parroting each other. And again, I am here to tell you, if you go back and verify this for yourself, okay? As markets top, we tend to see breadth narrow, not widen. As I said earlier, this is a manipulated, orchestrated, false move to the upside. It is not because we are taking more risk here. It is not because people are going to start aping into small caps. It is not because Bitcoin has to wait for permission for the Russell 2K to move into expansion, okay? It's not for any of this. This is a completely fake move to trap a bunch of people and let some bigger players out. As I was saying, we are this time around going to see breadth widen. And all of this makes me think that the market is setting itself up to get absolutely slaughtered here because people are just simply not understanding the mechanics of these third and final angles, these manipulated moves higher before we enter that global deflationary and recessionary bust that we are bound to see in the not too distant future, particularly given the way the unemployment rate is spiking, gold is breaking out, the dollar is still relatively strong, and the bond market is signaling cuts are coming, and those cuts are not going to be into normalization. So it's difficult. It's a wild time to be alive. A lot of people are going to get this wrong, but that is ultimately what makes a market. So as ever, we'll just keep taking this thing one day at a time. We'll keep letting the market prove me wrong. And if it doesn't prove me wrong, if it don't get invalidated, then we'll just stand on this assessment. We'll keep remaining long until it becomes unreasonable to remain long, all the while knowing where those major invalidations occur and being very mindful of where the cycles are so that we know which pullbacks are expected to bounce, and after those cycle lows are found, exactly what levels the invalidations sit at. I'm your boy Camel. I hope you're doing well in life. I hope you have a fantastic weekend. If you're a level 3 member, look out for that video I'm about to put out for you guys. And until next time, take care from me. All the best. Cheers. Bye.